Welcome back to the Dividend Diplomats YouTube channel, everyone. Lanny, Bert, the Dividend Diplomats. Today, we are pumped up. We are excited. We are going to talk to you about a company that just released earnings and saw their stock price plummet shortly after.
Guys, if you haven't done so already, smash that subscribe button. Give your boy Bert the Hurt and Lanny a nice thumbs up. As Bert says, we got a nice dividend stock here to talk about. With all of this volatility, Bert still went down. He put his research cap on. He's like, this is the stock we are talking about today.
Yeah, so what we're going to do is we're going to talk about this company. We're going to talk about their earnings release. We're going to run them through the Dividend Diplomat stock screener. And then we are going to tell you, are we buying, watching, or are we not even touching this stock? But you're going to have to wait till the very end of this video to find that out. Isn't that right, Lanny?
I'll tell you what, Bert, you're sounding a lot like a great 90s wrestler, on montage right there. Well, let me tell you something, Bert. We're going to definitely look at this dividend stock. The S&P 500 closed at over 4,400 on March 18th, brother. But that didn't stop you from finding an undervalued dividend stock. This one is definitely being impacted by the high gas prices right now at the pump, which has sent the prices south, but which means it could be time to buy a discounted asset for your dividend stock portfolio, Jack.
That's absolutely right, Lanny. We're going to get down into the ring. We're going to get there. We're going to battle on the road to WrestleMania up there. That's right. WrestleMania is coming here in a few weeks. We're going to roll up. We're going to fight these massive pythons here. We're going to talk about this company that is showing some strong results here, but they are facing those major headwinds going forward, which is causing that stock price to tumble.
You heard it right there, guys. So again, we're going to look at the three Dividend Diplomat stock screener metrics. One, the price to earnings ratio below the S&P 500 and the competitors. B, the dividend payout ratio, preferably less than 60%. That sweet spot, that Mr. Perfect 40 to 60%. Third, dividend growth rate. We need history of growing dividends because we want that passive income stream to grow without doing anything going forward, as well as can it reach above the growth rate of inflation, which is now sitting at pretty much 8%. Last but not least, we do look at the dividend yield as a bonus metric, the icing, the cherry on the top. This is what makes buying dividend stocks too sweet.
All right, let's jump right in. Let's get this first out. Well, actually, the only entrant into this video today is going to be a pretty clean video here. We can't wait to talk about this company. Looking out my front window to see if we're making sure one of their trucks aren't driving by, because they are going by your house, down your street multiple times today, which is why they are such an attractive company to so many. That company is FedEx, ticker symbol FDX. Let me rephrase that. FDX. There we go. We're gonna keep the wrestling theme alive. See how much we can get out of it in this video.
So guys, we're gonna dive into that price to earnings ratio, brother. They finished and closed $218.91, Bert. But now these analysts, they're getting very excited about FedEx, very excited about their prospects. They're thinking they're actually going to earn $20.62 in forward earnings. Pretty simple math here when you really think about it. They're going to have a PE ratio at just over 10 at 10.6, Bert. What do you think about that?
I don't think. I'm kidding. All right. That is a very low PE ratio, given the fact that the S&P is currently trading at a little bit below 25, give or take the day, the week, what's going on there. So significant discount compared to the market. Let's see how simple that second metric here is, that payout ratio. Is it as easy as calculate as that one was? Their annual dividend is $3. Pretty simple, right? So that gives you a payout ratio when you divide that by the 2062 forward EPS of 14.55%.
Wow. Say that one more time for the viewers.
14.55% payout ratio. So this company has plenty of room to keep on growing that dividend for years to come into the future.
And just to put a nice other frame of reference on that first metric again, that price earnings ratio, UPS is looking at it to be about a little over 16 times earnings. So FedEx is actually priced right now below UPS. Obviously, UPS had about a 50% dividend increase earlier this year. So we'll have to see, obviously, what FedEx has in store for all the dividend investors.
Well,
but
it's a
their
good
P
set.
ratio.
Yeah, I was gonna say it's almost a good segue right there. Let's talk about the dividend growth for the two companies or not the two companies, for FedEx while we're going through it. They've had an interesting 5-year dividend growth rate, particularly because they have only increased that dividend for one consecutive year in a row. They stopped increasing that dividend from 2018, and in June 2021, that was the first time they've announced an increase since they had that little pause. So that was before the pandemic, the company stopped increasing its dividends. So everybody, you got to keep that in mind too. This wasn't just a pandemic-induced pause. It was going on slightly before then, but the dividend growth is back. Their 5-year average dividend growth rate is 14% despite that. So think about that. 5-year average dividend growth rate per dividend investor is 14% with several years of not increasing that dividend. Phenomenal stuff right there.
Question is this going to be a stock that only increases their dividend once every few years, or are they going to go back into the consecutive increase mark here?
Well, I guess that's what we're going to find out here in June. I mean, this one's going to be interesting because you mentioned UPS had that banger of a 49% dividend increase last year. They already announced their 2022 annual dividend increase. So FedEx has not announced that increase yet, with a low payout ratio of 14% and plenty of room to keep growing that dividend. And a competitor that's already knocked your socks off with a 49% dividend increase. Let's see what FedEx has in store for shareholders. It should be something pretty sweet.
I like the sound of that. So guys, to get into that cherry on the top, that dividend yield, when you look at that $3, per year dividend, aka 75 cents per share per quarter, take that over the $218.91. You get a nice dividend yield of about 1.37%, which is just about the average yield of the S&P 500. So you might be buying FedEx for approximately same yield, but maybe better dividend growth rate.
That's I mean, nothing more to say right there. I think it's a great thing to ponder with it. So let's summarize these metrics here. PE ratio 10.62, payout 14.55, 5-year dividend growth rate 14.08%, one consecutive year of increasing that dividend, and a yield in line with the market of 1.37%. So some interesting metrics. Let's take a look at some of the numbers here in that recent earnings release. Total revenue. This is what's interesting. It was a very interesting press release when it comes to a pure number standpoint and what happened with that stock price. Quarterly revenue was 23.6 billion. Yeah, that's right, 23.6 billion, which was a 10% year over year increase compared to last year. Net income 1.2 billion, a 30% year over year increase from the comparable quarter last year. So the top line and the bottom line saw nice increases compared to the same time last year.
Guys, e-commerce and e-delivery is not going away. The shopping that's being done from your couch is only increasing. I know Bert's flipping up many items online right now. Let's just say that FedEx truck is pulling down his street, and I know my street for sure more frequently than not.
Yeah, we might be FedEx Smart Post at this point, by the way we're going through this, with how many times they're coming and going out of there. So yeah, I mean, you can see, like UPS, you see the trends going upward there for what's going on with some of those items. Now, the sentiment wasn't always there. There were some forward-looking things that were there were some forward-looking items that could potentially impact future performance of the company, which were reflected in the guidance. They're going to be facing some cost headwinds there. The cost for people is going up. Obviously, cost for deliveries are going up because what is going on with the price per barrel, Annie, and how may that impact their bottom line?
Well, for a long period, we were skyrocketing well over $100+ per barrel. We finally came back down below 100 recently, but again, still at near highs over the last handful of years at the price per barrel.
Yeah, so that has a major impact, obviously, because you got to operate these fuel-driven trucks driving around there somewhere. There have been some air disruptions here with all the issues with the airspaces over Russia, Ukraine, unfortunately, that are causing some headwinds there. So, I mean, some things that could there. Overall, though, not too much of a concern, because I'm going to put up here what the forward outlook from their earnings was. They're still forecasting diluted earnings per share of 1860 to 1960 before some accounting period end adjustments. Or earnings per share diluted that may show between 20.5 and 21.5. You'll see the full way that they get to that number. It's a mouthful. I'm not going through that. It might take another 25 minutes for you to back into that earnings per share. Listen to us talking through it. So look, we went through our stock screener earlier. Earnings per share from the average analyst were over $20 per share. Management showing it could be anywhere between the 18.50 and 9.25 using it one way, 21 this way. They're still going to crush earnings despite some of these headwinds. That's the moral of the story.
I think the moral story is green jacket, gold jacket. Who gives a no? So guys, FedEx again, low price to earnings, low dividend payout ratio, high dividend growth, lower yield, but that's what the high dividend growth is for. Big earnings growth, big revenue growth, clean balance sheet with a current ratio at 1.4 times. So they're covering their current obligations almost 1.5 times with their current assets. Yeah. So Bert, the question, is this a stock to buy right now?
52 weeks, they're down 20%. Year to date, they're down 15%. I don't know if this is a stock to buy right now because remember, metrics looking great, but UPS with that PE ratio of what, 16, their yield is significantly higher. Of course, it's going to be higher, and you do a 49% dividend increase there for UPS. So you may be paying a premium to FedEx with UPS, but UPS is still also a discount compared to the broader market as well. FedEx metrics look great, though. Can't hide behind that. Very low PE ratio, and the yield is lower than I like, but it's still in line with the S&P 500 now that the price fell. So I think it's going to earn a spot on that watch list going forward for the next few weeks to see what's going to happen. What are you thinking, Lanny?
Guys, it's on the watch list. This is one where, maybe very long-term investors who don't need the current income now can initiate a position for FedEx and buy and hold for the long term. Obviously, UPS is going to give you a little bit more current bang for your buck. You can't go wrong buying FedEx stock. I'll keep it on the watch list, kind of keep my eyes on it, maybe see if it ever approaches 1.5%. I have a pretty big position with UPS. I'm sure you do too. But always keep it on the watch list. Always keep your eyes out.
Yeah. So everyone, let us know below. What are you thinking? Lanny and I are both watching. Clearly, that's the takeaway. We're not buying. We are watching FedEx going forward. We want to hear your thoughts below. And if you haven't already, subscribe to the channel. Give this video a nice thumbs up. Let's keep going. Let's keep trying to find those undervalued dividend stocks to buy so we can grow our passive income stream. That is what it is all about.
Now, guys, that was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.